Joining us now for more on this is Todd, who's from FIIG Securities in Sydney. Mark, how significant has that rise been, and what should we make of that?
I think it's a very moderate rise. It's only up a point or so across the curve. We're not looking into that too. We don't think it's that significant. I think the RBA governor coming out yesterday with the minutes would point to, you know, they're saying that the growth isn't as significant as they thought it would have been. So logic would offer the fact that it might be a bit more expensive for corporates, and so the insurance play would be, you know, move this out a point or so, but it's not a significant number in our mind. I think if you look at, you know, broader markets, if you look at European and North American, you know, those movements have been much more significant, and so it may be an element of traders looking to take advantage of a very low base and starting to buy into it with the hope to, you know, flipping that trade.
So in terms of the underlying assets, there isn't that much concern from where you're sitting, and this is more about global jitters.
Yeah, I think so. I think if you look at the Australian corporate environment, or you know, if you were an investor in corporates in a global macro world, you'd probably want to go to Asia rather than, you know, North America or Europe. So I think it's just the underlying asset isn't really affected. It's just a movement in the actual asset itself, which is the CD, the credit default swap.
Traders doing what traders do, maybe. Now the
Exactly.
RBA, you alluded to it. It went as close to an acknowledgement of being wrong as it probably does yesterday in the statement. It's basically said that the forecasts from 2 months ago probably aren't on the mark. Is that significant for you?
I think it's more significant if they didn't respond. You know, if they look at the data and the data starts to shift, and we've been, you know, very predictive here. So if they see a shift in that data, I think it's good that they've come out. I think it's a sign of a confident RBA, and I think it's a competent RBA. So, you know, I hear a lot of people wanting to be a bit judgmental, but the market itself, you don't get time to judge it. It changes so quickly. So the expectations on the market on just interest rates alone has been so volatile over the course of the year. It's clear that the RBA is saying, well, the numbers are a little bit softer than we thought, and we want to bring that to your attention now. I think that's a good thing.
But maybe it shows the money markets were kind of ahead of the RBA in a sense. I mean, they haven't been pricing in rate hikes for some time now, have they?
Well, the RBA, money markets, you know, price on the daily basis. So, you know, we saw where those numbers came out on the building approvals down 7.9. The spike in that interest rate was, I think, fundamentally a short covering rally. So they're not being predictive. They're just saying, I want to get in the morning at 8:30 and start trading. And so they just trade on volatility and movement. So I don't think they're actually, I wouldn't give them that much credit, to be honest.
Now, and so we're not concerned that the RBA is off the mark and it's kind of lagging with its forecasts. You're not concerned about that at all. Does it sound to you like it's a central bank trying to prepare the market for further hikes? Delve a bit deeper into that statement for us.
Well, I think they're preparing the market for, in their initial expectations, I think, you know, looking into my view on the RBA, that they were expecting maybe one hike in the last quarter, and I think that's now off the agenda. So I think they'll be saying, let's push this a little bit further out the curve, and if we do see a rate hike, it'll be, you know, first quarter of next year. But at the moment, I don't see a rate hike on their agenda, and I don't think it's going to be on ours at the moment.
What about a rate cut next year? What could move us towards that?
I think you're looking at the headwinds that we see in I've alluded to, it's the North American movement, you know, the fact they're trying to manage their debt ceiling, and Europe. So if we start to see, I called it last week the Clayton's default in Greece. You know, it's the default you have when you don't have a default. If that starts to permeate around the rest of the globe, you could see the RBA saying, look, we better be proactive and start to cut rates. But I don't think they want to do any of that yet. I think they just want to let the market jitters, you know, affect the savings rates, affect the performance of the economy, and if they need to act, they can be, you know, pretty quick.
Mark, can we take you across to Europe as well in a bit more detail, with Portugal now getting the downgrade from Moody's, taking it into junk along with Greece. This is the very nature of the concerns of the market, isn't it? Contagion. Is it actually feeding through to the economy? We're seeing weaker data coming out of Europe now, even though the ECB looks like hiking rates tomorrow.
Yeah, they're in a very difficult position, and I think it's all around that confidence, and I don't see how you could be confident in any of the PIIGs. I don't think you can be confident in London. You know, England looks tough as well, so it's very hard to get consumer confidence, which will drive all of this business. You know, if you see the Chinese Premier out there in Europe looking at assets that it can buy, you know, they're trying to buy on the bottom of a cycle, and Europe and North America are trying to go through a structural change, and that's the thing that people are finding hard to come to grips with. It's not cyclical. So will the euro be able to support the evolution of their economies? That's the question that everyone's asking, which is a very structural question. And you know, I think it has to stay. The euro will have to stay. But how does the European community work when they don't have any political will? You know, the European community isn't run by one government, so it's very hard to create a political environment that says this is what we're going to do in Greece. I mean, I tell you, if a politician ticks off on something and says they're going to do it, you need to get the people down the back to agree to it.
Oh, and you're talking about Europe, not the United States there, when you talk political will.
Yeah, man, that's unbelievable.
Speaking of the debt ceiling debate, which happens in coming weeks, I mean, where does that all go?
Well, I think Bono and Obama know that they've got to get to an agreement, but it's very hard for them to, in their political cycle, you know, they're looking at an election year, so if you're the leader of the Republicans, you're trying to appeal to the Tea Party environment to win a selection, to get the nomination. So it's very hard for you to say, well, let's lift that ceiling when your voting base is saying, you know, I'm happy to try a default, let's see what it's like. It's a fundamental shift in attitude amongst these people where they're not working collectively, they're working against each other, and it's a combination of how the voter base has changed and where they are in the cycle. If you're looking for the nomination as a leader of the Republican Party, you've got to be really right-wing, and it's very hard to then bring that back and try and win the general election. So, you know, they're running this right down to the wire in August, and that's it just doesn't make sense to us. If I know we're critical of our own politicians, but could you imagine running right down to the wire in the last couple of days to work out whether you can fund the government? I mean, that's unbelievable. Yeah.
Mark, I have plenty more to chat to you about, but we'll have to wait till next time. Thank you. Always a pleasure. Mark Todd from FIIG Securities. Great.